What's up, future CPAs? Today, we are tackling a topic that, trust me, you are almost guaranteed to see on your exams. I'm talking about the dreaded dishonored discounted note. But don't worry, we're going to break it down step by step so you can absolutely crush this on the Lee CPA. Okay, so picture this, right? You're running your business, things are going great, but you're a little tight on cash. You need it now. But hey, you've got this note receivable from a customer. So you think, perfect. You take it to the bank, you discount it, and bam, you get that cash early. Everything's looking good.
But then, the maturity date hits. You get that phone call you never want to get. It's the bank. Your customer, yeah, the one who gave you the note, they didn't pay. They defaulted. Now the bank is looking for its money. So who do you think they're coming for? Who's really on the hook here? Let's dive in and figure this out.
All right, let's get right into it with a classic exam-style problem. This is the kind of thing you're going to see for sure. So let's break down how this actually works in the real world, or at least the world of accounting exam. So here's the setup. Your company is holding a 6 million peso note. It's a 9-month note with 10% interest. Simple enough. You go ahead and discount it at the bank. But then, on the due date, your customer flakes. They don't pay the bank. And just like that, the note is officially dishonored. These are the key pieces of the puzzle we've got to solve. Okay, before we start crunching any numbers, let's make sure we're all on the same page with the lingo. First up, maturity value. What is that, really? It's the grand total that was supposed to be paid when the note ended. It's not just the original P6 million. No. It's the principal plus all the interest it earned over its entire 9-month life. Think of it as the final price tag on that loan.
And then you've got this thing called a protest fee. This is basically the bank's way of saying, hey, this whole thing was a hassle. It's a legal fee they charge to officially document that the note was dishonored. It's kind of like a penalty for the default. And guess who gets to pay it? Yep, you do.
And here's the absolute key takeaway. When your customer defaults on that note you discounted, that liability, it's like a boomerang. It comes flying right back to you. The bank isn't going to waste their time chasing your customer. They've got your signature. They're coming straight for you. So, how do we figure out exactly how much you owe the bank? It's actually a super simple 2-step process. First, we need to calculate the note's total maturity value, that's principal plus all the interest. Then, we just tack on the bank's protest fee. Add those two together, and that's the total cash you got to hand over. Let's do the math. We start with the principal, 6 million pesos. We multiply that by the 10% annual interest rate. And since it's only for 9 months, we multiply it by 9/12 of a year. That gives us a total interest of 450,000 pesos. Easy peasy. Okay, so we've got our interest. Now, finding the maturity value is a piece of cake. We just take that 450,000 in interest and add it back to the original 6 million principal. And there you have it, a maturity value of 6,450,000 pesos. All right, we're almost there. Let's finish this calculation. We take that maturity value, the P6,450,000, and we add that pesky 50,000 peso protest fee. And that gives us our grand total, a nice round 6,500,000 pesos. Yeah, ouch. That's a big check to write.
So you've just paid the bank a huge chunk of change. Now what? Well, as accountants, we've got to record it, right? Let's move on to the crucial journal entry and see how this whole story gets put down on the books.
Okay, lean in, because this right here is your big LECPA study hack. This is the mental switch that makes everything click. The moment that note is dishonored and you pay the bank, it stops being a note receivable. Poof! It transforms into a regular old account receivable. And who does the customer owe now? They owe it directly to you.
And once you get that, the journal entry just makes perfect sense. We're going to debit accounts receivable for the full 6.5 million. Why? Because that's the brand new debt our customer owes us. And we credit cash for that same amount because that's what we just paid out. You've basically just traded your cash for an IOU from your customer.
But hold on, the story doesn't end there. Just because your customer goes to the bank doesn't mean you're totally out of luck. Now, you get to put on your collector hat. It's time to go get your money back and maybe even a little extra.
And you know what? Here's the silver lining. You don't just get to collect the 6.5 million you paid. Nope, you can also charge the customer penalty interest for making you wait. So let's say 3 months go by before they finally come around to pay you. For that whole time, you can charge them a 12% penalty interest. Sweet, right? So let's calculate that penalty. We take the new AR balance, the whole P6,500,000, we multiply that by the new penalty rate of 12% and then by the time frame, which was 3 out of 12 months. And that works out to an extra 195,000 pesos in interest income for you.
So, let's add it all up. The grand total you're going to collect from this customer is the P6,500,000 plus that new penalty interest of 195,000. The final cash hitting your bank account is 6,695,000 pesos. Not bad.
And of course, we need one last journal entry to tie it all up. You debit cash for the full $6,695,000 that just came in. You credit accounts receivable to wipe that $6,500,000 debt off the books, it's paid, and finally, you get to credit interest income for that extra $195,000 you just earned. And just like that, this whole saga is over. Problem solved.
Whew, okay, I know that was a lot to take in, but you hung in there. Now, to make absolutely sure this stuff sticks in your brain for exam day, we've cooked it all down into one super powerful review slide. Think of this as your ultimate cheat sheet for Dishonored notes.
All right, let's run through it fast. The Dishonored Note Playbook. When it's dishonored, you pay the bank the maturity value plus the protest fee. How do you get maturity value? Principal plus interest. What's the first journal entry? Debit accounts receivable, credit cash. Simple. Then, when you collect, you get back your AR plus new penalty interest. And that final journal entry? Debit cash, credit AR, and credit interest income. Seriously, screenshot this slide, memorize it, make a part of your DNA.
So I'll leave you with this one final thought to really lock this in. What is that one mental shift we talked about? The one that takes a super confusing dishonored note problem and makes it a crystal clear, straightforward accounts receivable problem? Really think about that, because internalizing that one idea is the key. That's how you get these questions right every single time on the exam. You got this.